Here is a number most people have never heard, and it may matter more than any missile fired in the last 5 months. 52%. That is roughly how much shipping traffic through the Strait of Hormuz fell in a single week this July, according to tanker tracking data from Kepler. No blockade was declared, no new closure was announced, ships simply stopped going. Captains and insurers made a quiet calculation that the risk was no longer worth the cargo. That is the part of this war that rarely makes the headlines. We watch the missile strikes, we watch the ceasefires collapse and reform, but the deeper story is being written in oil tankers rerouting around the Cape of Good Hope, in insurance premiums that have multiplied overnight, and in a Federal Reserve that has gone from planning 4 rate cuts this year to debating whether it needs to raise rates instead. This is a war being fought with missiles in the Persian Gulf, but it is also a war being fought with basis points on Wall Street. And by the end of this analysis, you will understand why the second front may end up shaping American life longer than the first. Since the end of February 2026, the United States and Israel have been engaged in an escalating military confrontation with Iran that began with strikes on Iranian military infrastructure and the killing of Iran's supreme leader. Iran responded by closing the Strait of Hormuz to foreign shipping, a waterway through which roughly a fifth of the world's oil and gas has historically passed. What followed was not a short, contained exchange. It became a months-long campaign of strikes, a U.S. naval blockade of Iranian ports beginning in mid-April, and repeated rounds of escalation and de-escalation, including a short-lived diplomatic understanding that collapsed within weeks. In mid-July, the fighting intensified again. American forces carried out several consecutive nights of strikes aimed at degrading Iran's ability to threaten commercial vessels near Hormuz, including an operation against Greater Tunb Island, one of a handful of islands Iran has used to project control over the strait. Iran, in turn, struck tankers linked to Gulf states and triggered missile alerts as far away as Bahrain and Kuwait. Each side insists the other broke the peace first. That argument will likely never be settled to either side's satisfaction. What can be measured, however, is the economic shockwave radiating outward from every one of these exchanges, and that shockwave has become the real subject of this story. It would be try to treat this as a regional conflict with a regional cost. It is not. The Strait of Hormuz is one of the narrowest choke points in the global economy, and disruptions there do not stay contained to the Gulf. They travel through the price of a barrel of crude, into the cost of jet fuel, into the price of the plastic in a child's toy, into the interest rate on a mortgage refinance, and into the return on a retirement account sitting in an index fund. This is the mechanism by which a war 8,000 miles away becomes a line item on a household budget. And because the transmission is invisible, it moves through insurance contracts and futures markets rather than through visible destruction. It is easy to underestimate. A missile strike is a single dramatic event. An insurance premium tripling is a slow leak. Slow leaks are more dangerous precisely because they are harder to notice and harder to politically address. To understand why this conflict behaves so differently from a conventional war, it helps to understand what actually happened to global oil markets over the last several months. When the war began in late February, oil was trading in the high 60s per barrel. As the conflict escalated through March and the Strait came under threat, Brent crude climbed above $85, and by early April, at the peak of the crisis, prices spiked to roughly $115 to $118 a barrel, territory not seen in years. U.S. gasoline prices moved in lockstep, and electricity costs, which are tied to natural gas in large parts of the country, rose even faster. Residential electricity prices climbed more than 6% year over year, even before the worst of the crisis hit. Then something counterintuitive happened. By mid-July, crude had fallen back to around $74 a barrel, well below its wartime peak, even as the military conflict itself reignited with fresh strikes and tanker attacks. Falling oil should, in theory, cool inflation. Instead, U.S. inflation kept climbing, hitting a 3-year high near 4.2%. That divergence is the single most important and least understood economic fact of this entire war, and it is worth explaining carefully because it goes to the heart of why this conflict is more dangerous to your finances than the oil price alone suggests. The military logic driving this economic story is what strategists call a commitment trap, a situation where both sides believe that backing down costs them more than continuing to fight. Washington has framed its objective as guaranteeing freedom of navigation through Hormuz, control, in President Trump's own words, over the whole strait. Iran has framed the fight as resistance to a blockade it says is strangling its economy, with U.S. officials estimating the naval blockade alone is costing Iran roughly $500 million a day. Neither side can afford politically to appear to have lost. That dynamic explains why ceasefires in this conflict have been short-lived. An interim U.S.-Iran agreement reached in June, intended to reopen the strait and provide 60 days of negotiating room, unraveled within weeks once each side accused the other of violations. The military picture also includes a geography lesson that matters economically. Iran does not need to sink a supertanker to disrupt the strait. Control or contested control over a handful of small islands near the mouth of Hormuz, Greater and Lesser Tunb among them, is enough to let Iranian forces threaten passing vessels, which is precisely why the U.S. has targeted them directly. The strategic prize here is not territory in the traditional sense. It is leverage over a 14-mile-wide shipping lane that carries a disproportionate share of the world's energy. This is where the story becomes genuinely counterintuitive, and where most casual coverage gets it wrong. The initial economic shock of this war was a classic supply-side oil spike. Prices at the pump rose because the market feared a physical shortage. That fear peaked in early April near $115 to $118 a barrel, and the Federal Reserve, then still under Chair Jerome Powell, held rates steady while projecting only a single rate cut for the year, down from 4 projected cuts before the war began. But as the months wore on and oil prices began to retreat, even amid continued fighting, a second, subtler inflationary channel opened up. Core inflation, which strips out food and energy, kept rising. Federal Reserve Bank of Dallas researchers have estimated the war added roughly 0.6 of a percentage point to headline inflation and 0.2 to core inflation by the end of the year, driven not by the oil price itself, but by the lagged effects of rerouted shipping, elevated insurance costs, and higher input prices working their way through supply chains months after the initial shock. This is the hidden war tax in its purest form, a cost imposed not by any single price spike, but by thousands of small, compounding price increases across the entire economy, from airline fuel surcharges to chemical manufacturing to farm equipment operation. By July, with a new Fed chair, Kevin Warsh, at the helm, the probability of a rate hike, not a cut, by the September policy meeting had surged from roughly 1 in 4 to nearly 3 in 4, according to CME Group's FedWatch data. That is a remarkable reversal. An economy at war with a major oil producer somehow arguing for tighter, not looser, monetary policy, because inflation has stopped behaving like a simple energy story and started looking like a structural one. To really understand the American cost of this conflict, it helps to walk through what has happened to 5 separate markets since late February, because each one tells a different piece of the story. Start with Treasury bonds. In the opening 2 weeks of the war, the yield on the 10-year Treasury note surged from roughly 3.9% to above 4.2%, as investors concluded that the oil shock would keep inflation elevated for longer, which forces the Federal Reserve to keep rates higher for longer. Higher yields ripple almost immediately into mortgage rates, auto loans, and the interest the U.S. government itself pays on nearly $40 trillion of national debt, a bill already running close to $1 trillion a year, even before accounting for a Pentagon request for more than $200 billion in supplemental war funding. Technology and growth stocks were the most visible casualty of that bond move, because tech valuations depend heavily on future earnings discounted back to the present. A rising 10-year yield acts almost like a tax on optimism. The Nasdaq fell into correction territory in the war's early weeks, even as headline stock indexes elsewhere held up better. That divergence is a useful lesson in itself. A geopolitical war doesn't hit every sector equally. It hits the sectors most dependent on cheap, long-duration capital hardest, and tech is the purest example of that exposure. Defense stocks moved in the opposite direction, and for an intuitive reason. Aerospace and defense manufacturers saw share prices climb toward record highs within days of the war's outbreak, as investors priced in years of elevated munitions demand, missile defense spending, and a Pentagon budget request that came in roughly 50% above the prior years. Call this the mirror image of the tech story, Where uncertainty destroys value in one sector, it manufactures it in another. Gold's behavior is the counterintuitive plot twist of this whole conflict. In a textbook crisis, gold is the safe haven that rises when everything else falls. Instead, gold suffered one of its worst weekly losses in more than 4 decades in the war's early weeks, because surging Treasury yields offered investors a competing, interest-bearing safe haven, and central bank buying out of India and China, which had propped up gold through 2024 and 2025, quietly paused at elevated prices. The lesson here is subtle but important. Safe haven behavior isn't automatic. It depends on what else is competing for the same nervous money. And the dollar did what dollars typically do in a global scare. It strengthened, gaining roughly 2 to 3% against a basket of major currencies in the opening weeks as international capital sought shelter in U.S. assets, even though the crisis originated in a conflict the United States was actively fighting. A stronger dollar quietly helps American consumers by making imports cheaper, even as it complicates life for U.S. exporters and for emerging markets that borrow in dollars. Put these 5 threads together: bonds, tech, defense, gold, and the dollar, and you get a far more complete picture than "oil went up" ever could. This war has been redistributing capital across the American economy for months, rewarding some sectors and punishing others, long before most households noticed anything beyond the price at the pump. There's also a domestic, political, and fiscal layer to this story that rarely gets attention outside of Washington trade publications. Fighting a war of this scale is not free, and the bill is arriving in more than one currency. Beyond the direct defense supplemental request, the federal government's finances took a separate, unrelated hit this year when the Supreme Court ruled the president lacked emergency authority to impose a set of tariffs, a decision that could require roughly $175 billion in refunds to importers, money the administration says it will attempt to recoup through alternative tariff authority, though it's not yet clear that revenue gap closes completely. None of this is catastrophic on its own, but it lands at the same moment as elevated interest costs on the national debt and a war-driven inflation problem, which narrows the room policymakers have to maneuver if growth slows or a new shock hits. This is the quiet arithmetic behind why Federal Reserve officials, under new Chair Kevin Warsh, have described the situation as leaving little margin for error. Diplomatically, this conflict has repeatedly demonstrated a pattern worth naming explicitly. Ceasefires here function less as endings and more as pauses that reset the clock on escalation. The interim agreement reached in June, brokered in part through meetings involving Vice President J.D. Vance and regional partners including Qatar and Pakistan, briefly reduced tanker traffic risk and pulled oil back from its highs. Its collapse in early July, followed almost immediately by a fresh round of American strikes and Iranian tanker attacks, illustrates why markets have started pricing this conflict differently than they priced earlier Middle East crises. Traders no longer treat a ceasefire as a signal to fully unwind their hedges, because the base rate of these agreements holding has been poor. That skepticism itself has an economic cost. War risk insurance premiums, once the domain of a narrow set of maritime underwriters, now function as a kind of real-time probability gauge for renewed conflict, and underwriters have been slow to lower them even during quiet periods, which keeps shipping costs elevated longer than the headlines alone would suggest. There is a useful historical parallel here, though it is imperfect, as all historical parallels are. In 1973, the Arab oil embargo quadrupled oil prices within months and helped trigger a decade of stagflation, high inflation paired with weak growth that reshaped American economic policy for a generation. The mechanism was similar to what we're seeing now, a geopolitical shock in the Middle East disrupting energy supply, which then bled into broader prices through transportation and manufacturing costs. But there is a critical difference. In 1973, the embargo was a deliberate, coordinated supply cutback by oil-producing nations working in concert. What we are watching in 2026 looks more like an accident of infrastructure, a single choke point contested by 2 militaries, where the damage comes less from a coordinated policy and more from the accumulated caution of thousands of individual shipping companies and insurers responding to daily uncertainty. That makes this crisis harder to resolve through a single diplomatic agreement because the supply cutback here is not a decision one government can simply reverse. It's an emergent property of risk perception across an entire global shipping industry, which is exactly why oil fell to $74 even as the fighting resumed in July. The market is no longer pricing a single embargo. It's pricing a chronic, unpredictable hazard, and chronic hazards get priced differently than acute ones. Given where things stand, there are three broad paths this could take from here. The first is a controlled but costly confrontation. Strikes and counterstrikes continue at a manageable tempo, the Strait stays technically open but expensive to use, and the American economy absorbs a slow-burning inflation tax without a full-blown crisis. Something closer to what the Dallas Fed's models describe, a sustained but moderate drag on prices and growth. The second is a dangerous regional escalation, an attack that damages a major Gulf energy facility, closes the Strait outright for a sustained period, or draws in an additional regional power, which could push oil back toward or beyond its April highs, near $115 to $120 a barrel, and force the Federal Reserve into the uncomfortable position of raising rates into a war-driven inflation spike, precisely the scenario currently gaining probability in futures markets. The third is a negotiated pause that holds longer than June's did, not a full peace settlement, but a durable enough truce that insurance premiums ease, shipping normalizes, and both oil prices and core inflation begin to genuinely retreat rather than merely oscillate. None of these paths eliminates the underlying commitment trap. They simply describe how long it takes, and how expensively, for one side or the other to find an exit that doesn't look like defeat. The single most important idea in this entire analysis is the distinction between a closed strait and a dangerous strait. A fully closed Strait of Hormuz would be a dramatic, headline-dominating emergency, and in fact, this war has already produced exactly that scenario earlier in the year. But what markets are contending with now in July is arguably trickier. A strait that is nominally passable but expensive and unpredictable enough that the costs spread quietly through the entire economy rather than arriving all at once. That is why oil at $74 a barrel can coexist with the highest inflation reading in 3 years, and why a war that looks, on the surface, less acute than it did in April can still be pushing the Federal Reserve toward tightening rather than easing. The danger, in other words, has not gone away. It has simply changed shape. Wars are usually measured in territory gained, casualties reported, and ceasefires signed and broken. This one will also be measured in a currency most people never think to check: the compounding cost of uncertainty, tallied in insurance contracts, shipping routes, and central bank meeting minutes, until it eventually arrives, quietly, and without a headline of its own, in a grocery bill, a utility statement, or a 401k balance. The Iran war is no longer only a story about missiles and territory. It has become a story about who controls risk in the global economy. And until that question is settled, the cost of this conflict will keep finding its way into American households, one small price increase at a time. If you found this analysis valuable, subscribe to On Air Experts for in-depth coverage of global affairs, strategic developments, and the stories shaping tomorrow's world.